Good morning, everyone. I'm Jenna.
And I'm Jennifer. I'm a certified divorce financial analyst here at Tranel Financial Group.
Awesome. It's great to have you here today.
Thank you.
Today, we want to talk about assets, right? It's all about the assets. But in reality, what does that mean, right? When we talk about assets, that is such a broad term that can be interpreted in many different ways. But let's hone in, right? You're a certified divorce financial analyst. What does that mean when someone talks about assets and they come to you? How do you associate that with divorce? I'm assuming there's multiple different ways, like marital, single.
Yes.
How does that work?
And there's been a couple things that have come up lately where I was like, okay, well, maybe we need to define what an asset is. And there's two really big areas I want to talk about today. And one is, what is a marital asset and what is a non-marital asset? So having the clarification, because when you're asked for a divorce or you're thinking about going through a divorce, the first thing you want to see is, okay, with my finances, what do I have? Like, what are we talking about?
Right.
So really defining marital assets and non-marital assets, and then finding out what are like assets. And what do I
new
talk
term.
about there? Yeah, like assets. I always like want to, throw some new terms out now
Love
and then.
it.
But what is a taxable asset and what is already been taxed or a non-taxable asset?
Okay.
So really defining those so we understand when we're negotiating or coming up with just what are the division of assets, what does it mean? And is $100,000 really $100,000 or is it $80,000 after taxes? So
is that something, so if I can interrupt you really quick.
Of course.
Is that something that you would learn from the lawyer, or would you have to partner with an actual financial advisor or CDFA to learn the difference between all those different asset types?
I would go to a financial professional. A lawyer that sees this every day, of course, is going to know what an asset
Yes,
is.
of course.
And they're going to understand, but a lot of times what they don't understand or where their expertise doesn't lie is comparing if you're going to take a 401k asset over equity in a house. And we'll talk about that in a minute.
Okay.
So really, what are the complications or what are the projections of what that asset means later, like in 5 years? And that's where lawyers will hire or recommend their clients go to a CDFA or financial advisor for that advice. So that's where it comes in. Because lawyers see this all the time.
Of course. But just because
what does it actually
it,
mean? Yeah,
right.
we can divide everything out, but what does that mean for you in your future? And this is why you hire a team.
Right.
So the first thing I want to go through is a marital asset versus a non-marital asset.
Okay.
So a marital asset is an asset that was earned, so income earned, interest made, asset that you acquired during the marriage.
Okay.
And it doesn't have to be in a joint name. So if me and my husband, I have separate accounts and I have my income goes into my account and I never put his name on there, but we end up getting a divorce, that is still a marital asset. So just because you do not put, during marriage, do not put a name on your account that your money is coming in that you're earning during marriage, doesn't mean it's a separate asset. That means it's a marital asset.
Okay. And prenups they would lay something out if that was different?
Correct.
Okay.
We can go in a whole different.
Yeah, sorry.
Whole different thing on
another
there.
video for another day.
Yes.
Sorry.
But a non-marital asset, so say you had a life or some sort of asset like a savings account before you got married.
Okay.
And you had that account and that stayed separate. So let's talk about $10,000.
Okay.
And that stayed in a savings account and you never put more money into that account.
Okay.
Then that's going to be a non-marital asset.
And never put his name on it.
Exactly.
Okay. That makes
Once
sense.
you put a name on it, once you put money in from earnings or money that was marital, then that becomes a marital asset.
Got it.
So that's called commingling.
Okay.
And that can be a really gray area. So you want to make sure that you understand what has happened during the marriage, and the timelines are very important to have laid out.
Okay.
If you got an inheritance during marriage and that stayed separate, so your parents passed away or grandparents passed away, that money came to you and you put it into a separate account and never put more money into it from earned marital money, then that's also a separate asset.
Okay.
It could be taken into consideration for need of income, other things like maintenance, but other than that, it's a non-marital asset.
Makes sense.
So that's where, you really just want to understand, lay out all your assets, your house, your checking accounts, your investment accounts, and see the
401k.
timelines of, did you have them before marriage? Did you have them after? Did you put your spouse's name on that?
Right.
And did you put money that was earned during marriage in there?
Okay.
Because then you've now commingled the assets.
Makes total sense.
But I'm very good at digging through all of the statements and looking at the timelines and just having you understand what your situation is and what we're looking at.
Absolutely.
Definitely there's gray areas. Nothing's black and white, especially in divorce. But definitely good to have the but some financial person that's seen this over and over again say, okay, this is, you're safe here. This is where you have to split and whatever the splitting guidelines are.
Okay. Oh my gosh, that's crazy. And then as soon as you add the layer of prenuptials into it, that's just a whole nother ballgame. But you actually go through the statement. So part of when someone works with you, partners with you, you actually go through all of their statements and understand a timeline in there. Okay, that's interesting.
Yes, very.
It's also a lot of work.
It is a lot of work, and it's very helpful for the person and the client and the lawyer as well.
Of course. That's why they partner.
So the next thing I want to go into quickly, I just want these videos to be very helpful, but not
This is helpful. I'm
overly
learning.
long, right?
Yeah, I'm learning.
But what is a like asset? So now you
that is
know
a great question.
what your assets are.
Okay.
What is marital? What's on the table? Now we're looking at the two of the biggest assets that a person has normally is their house,
Right?
and their retirement.
Fair. Yep.
So that grows, you're putting money in, especially if you are later in life or later in the marriage getting a divorce. Those have grown substantially.
Of course.
So the equity in a house is normally not taxable if it's under a certain amount.
Okay.
So it's $250,000 right now, current day, 2021. So if you've been in your house for 2 years, $250,000 is the exclusion per a person.
Okay.
So $500,000 married.
Okay.
So if you sell your house and you pay off the loan, and what goes into your account for for simplicity is
Love it.
less than $250,000 for you, then that's not taxable.
Okay. That makes sense.
So that asset, when you're staying in the house, and now you have equity. So say you have $100,000 of equity, and $50,000 you have to pay out because the other person, that's a marital asset, the other person is owed $50,000 from the equity. You can refinance, but sometimes if a refinance is impossible or other things come into play, the next thing people will say is, well, I have that money in my 401k.
Okay.
Well, the 401k, if it's not a Roth, right? So I'm trying to give a little bit of explanation here. The 401k hasn't been taxed yet.
Right.
So the money has not been taxed yet. That's taxed at retirement. And it's also meant if you're 59 and a half, then you can reach that money. But if you're under 59 and a half, you're going to have a 10% penalty.
Okay.
So penalty tax on the 401k. So if you're saying, well, you know what, let's just give $50,000 so I don't have to refinance or I don't have to touch the equity in the house. Well, now you have a 20% or whatever your tax bracket is. I'm going to say 20% tax. Then what?
Right.
So now, what's going to happen now that $50,000 isn't worth $50,000, it's worth less than that. So you want to look and see and if you're on the other end of that and now you're being taxed, you were owed $50,000 and now you're only getting $40,000 or $45,000. It's not going to be fair for you.
Okay.
Plus the penalty.
Fair.
So really looking at, a checking and savings account, usually those have already been taxed, right? You get a 1099 every year.
Okay.
The Roth IRA is not taxed. The
Okay.
money you've already taken, the money has already been taxed from your earnings, and you put that money into a Roth IRA. So that money has not been taxed. So that's after tax money. And then house proceeds are normally, you have to look at the exclusions, not taxed as well. So those are all like post-tax. And then pre-tax is going to be your 401ks, 403bs, 457s, and pensions, so your retirement money.
Okay.
So when comparing those and using those to offset, you want to make sure you understand the real value or the net value of those assets.
Oh, wow.
And I help you go through all the details. I talked in very general terms today, but those are important considerations to take.
Absolutely. And really, again, as you said, a lawyer sees it, which is important. They have a strong understanding of it, but then really truly working with a professional to actually go through and literally comb through those pages to lay out that timeline so that you are safer down the road, right? In 5 to 10 years. Sorry.
Yeah, what does that mean?
Yeah.
What does that? No, it's okay. What does that mean 5 years from now for the growth and growth projections? And that's just very important for your planning and your new life after divorce.
Absolutely. And the important option or important thing to know is that a certified divorce financial planner, whether it's Jennifer or someone else that you're working with, continues to work with you afterwards, right? To make sure that you are, or help you to prepare for the future. Because, right, we all know that a plan is living. It molds, it changes as things happen. If you decide to get remarried or something of that nature, that's why you work with a financial planner post-divorce as well.
Exactly.
So, please feel free to reach out to us if you have any questions. And we will do another video on prenups.
There we go.
Next
video is planned.
We're interested. Thank you.
Thank you.